liquidity sweep. In this setup, the market breaks the level with one strong candle during the trading session. Then immediately after, an opposite candle appears and closes back above or below the level. This type of liquidity sweep is more controlled and deliberate. It reflects a well-thought-out institutional move designed to manipulate breakout traders before reversing price. This setup is powerful because the market first creates the illusion of continuation, then suddenly changes direction. The third type, multi-candle liquidity sweep. This is one of the strongest forms of liquidity manipulation. Instead of creating the sweep with one candle, the market slowly pushes beyond the level using multiple candles. This movement encourages more traders to believe the breakout is real. More breakout traders enter the market. More stop losses get triggered. And then suddenly, the market reverses aggressively and closes back above or below the level. This type of sweep is extremely powerful because the liquidity trap becomes very clear. The market spends time building the illusion before attacking in the opposite direction. And this is exactly how institutions trap emotional traders. Now let's talk about weak liquidity sweeps. If the sweep forms with a tiny wick, weak rejection, small candles, or no strong momentum shift, then the move is often meaningless. Sometimes, this is nothing more than normal price fluctuation. Remember, a real institutional liquidity sweep usually creates strong rejection, emotional trapping, volatility, and a clear reaction from the market. Weak sweeps without conviction should be ignored, because the goal is not to trade every sweep. The goal is to trade only the sweeps that reveal clear institutional intent. Now look at this chart example. This is the British pound and Japanese yen on the 5-minute chart. This is the most recent major swing high, and this is the most recent major swing low. Now look at what happens next. The market retraces back, breaks above the resistance level, and then suddenly closes back below it. This is a valid institutional footprint created by a long wick liquidity sweep. The move is fast, sharp, and aggressive. This tells us that the breakout failed and that buyers were trapped above resistance. So this is where you can execute the trade. You place your entry at the close of the rejection candle. Your stop loss goes above the wick, and your target is the next major swing low. Now look at what happens next. As you can see, the market drops directly into the target. But now pay attention carefully. Look at what happens next. The market breaks below the most recent swing low, which acts as a support level. But instead of continuing downward, price suddenly reverses and closes back above the level. This is a liquidity sweep formed with multiple candles. And this is one of the strongest types of institutional manipulation.